Hello, my name is Paul Hurley and I'm with M&T Bank. Today we're going to talk about qualifying for a mortgage loan and what banks look for. When you're qualifying for a mortgage, you can break it down into the 4 C's: capital or cash, capacity to borrow money, credit history, and collateral, or the property that you're purchasing. First, in capital or cash, banks want to see that you're going to have sufficient money to close on the loan. This is going to go to several different places. This is going to be used for your down payment, your closing costs, your escrows, as well as some of the things that you're going to need to do following closing, including moving, repairs, and minor purchases. The sources of this money can come from a number of places. These would include your savings, gifts, grants, or a seller concession. As far as cash and savings goes, banks are generally going to be looking to see 2 months worth of bank statements to see where your money has come from. If there's any large or unexplained deposits into your accounts, the banks are going to ask you where those are coming from. Gifts are allowed to come from family members, and we just need to track where that money is coming from. Grants come from a number of different agencies throughout the area that you're looking to purchase. And a seller concession is essentially when the seller agrees to help you pay for some of the costs out of the proceeds of their sale. The next thing that we're going to be looking to see is your capacity to afford the loan. In other words, how much of a mortgage can you afford? We're going to look at your income as well as your liabilities. Income comes in a number of different sources, including your pay, salary, overtime, commissions. You may receive non-earned income, such as pension or Social Security. If you're self-employed, we're going to want to see 2 years worth of tax returns. If you receive any sort of part-time income, bonuses, we're also going to need to see your tax returns, and we're going to need to see a 2-year history for these. If you receive alimony and child support and you wish to use it for qualifying for a mortgage, you can do that. Banks are looking to see that you have stable and reliable income. Typically, we want to see a 2-year history of where your income is coming from. You may change jobs as long as you're staying within the similar field and as long as the income remains stable and reliable. In addition to your income, the other half of the affordability of a mortgage is, what do you owe? What's on your credit report? Car loans, student loans, personal loans. We're going to use minimum payments on your credit cards. Do you pay alimony, child support, or maintenance? That does need to be included. When your lender talks to you, you're going to hear us talk about things such as debt-to-income ratio. Typically, we don't want to see that your mortgage payment exceeds 28 to 33% of your income. And we really don't want to see your total debts, that's your mortgage payment, plus the rest of your monthly income, exceeding 40 to 45%. Different programs will have different guidelines, and different grant agencies will also have different guidelines. So it's important that you talk to your loan officer and let them know what it is that you're looking to do and whether or not you're getting grants, so that we can make sure that we're using the correct ratios. We're also going to take a look at your credit history. We're going to pull your credit from all 3 credit bureaus. If you want to know what your credit looks like before coming to a mortgage lender, you can go to annualcreditreport.com, which is the government-backed credit reporting agency, which will give you all the history for all 3 of them free once a year. Each of your credit reports is going to have 3 scores on it. We typically use the middle score. If there's 2 borrowers, we're going to use the low middle score to determine which is going to be used. We generally want to see 3 to 5 different trade lines on your credit report, including credit cards, car loans, student loans, personal loans. We want your credit lines open for between 18 and 24 months with a positive credit history. The higher your credit score, the easier it's going to be for you to get through, and the better terms that you're going to get as well. Okay? Are you paying on time? What do you owe on your credit report? How old are your accounts? Newer accounts, or if you're maxing out your credit cards, that's going to hold your score down. What is the mix of credit that you've got? In other words, do you have a couple of credit cards as well as an installment loan? That's going to give you your best options. How many inquiries have you had? How many people have pulled your credit in the last 90 to 180 days? If you don't have a credit history, don't despair. There are programs that will allow us to use non-traditional or alternative sources of credit. This is going to include things such as your rental history. We can get information from utilities if you pay them, automobile insurance, as well as cell phones. These are called alternative credit, and we're basically going to go back and get a history of the payment on these to help build a credit history for you. There are a number of different mortgage products available, so the one that fits you best may not be the same one that fit your brother or your coworker. Each one of these programs has its own special niche, okay? FHA, Fannie Mae, conventional, rural housing, and VA loans are just some of the different ones available. With an FHA is probably the most user-friendly when it comes to credit. So if your credit history is a little bit dicey, your loan officer may recommend that you go with an FHA because that's going to be one of the easier ones to get into. For low to moderate income, first-time home buyers, Fannie Mae happens to be a personal favorite of mine. It offers nice low interest rates. It offers some down payment assistance. It's also coming out with some new products for some less than perfect credit and some enhanced closing cost features as well. Conventional mortgage is what you typically hear, a Fannie Mae, a Freddie Mac, just a standard 30-year fixed rate product. This might be for somebody that doesn't fit into the Fannie Mae guidelines if their income is a little bit too high. If you're purchasing outside of the main areas, maybe out into the more rural areas, rural development or USDA allows for 100% financing. It also allows the seller to assist with your closing costs, so you can get in with a little bit less money out of pocket. And then you have VA loans. VA is for veterans. It is 100% financing. It does allow for the seller to pay all of the closing costs and prepaids. It has competitive interest rates, and it's a great program, again, for first-time home buyers looking to purchase a loan in that manner. Next steps. You're going to want to contact a loan officer to get yourself pre-qualified. Let them know, what you're looking to do. Let them know how much you're hoping to spend. Ask about their specific first-time home buyer programs. Not every lender offers every loan, and some lenders will offer specific in-house programs that other banks don't have. Find out how you can qualify for the best loan products. Contact your local housing agency to complete your home buyer education and talk about any potential grants that may be there. And most of all, enjoy the process. This is a great time to be looking for a home. Thank you.